Hi, believers. This is Nishant from the Waya team. The markets are driven by liquidity irrespective of how well the economy does. The same is the case for India. Yes, we are among the most expensive markets globally because of potential to grow and our robust economic fundamentals. Today, I will take you through the major indices of our markets and also throw some lights on the US interest rates and liquidity position globally, which is spooking the markets due to Japan's policy. Starting with the Nifty index, due to global market sell off, we may see Nifty to touch the levels of 24,400 to 24,100. The most important level we see is 23,900 because this is also an important Fibonacci level. If we break below this, then we may fall towards 23,300. The earnings of Nifty 50 stocks have not been impressive, considering the index is trading at 23 times trailing PE. The valuation is definitely steep. Therefore, we believe that we may see a healthy correction considering the global market situations as well. Moving to Bank Nifty Index, the major banks continue to face selling pressure at the higher levels. This is mainly because FIIs keep selling the banking stocks, as they have substantial stakes in most of the Indian banks. HDFC, ICICI, and Axis each has 40% minimum 40% stake of FIIs. Therefore, the banking stocks have been underperforming the broader markets for more than a year. The key levels to watch out for is 50,500 because if we close below this, we confirm a lower low. But 50,000 is a psychological level at which the index also gets a support from the valuation perspective. Therefore, 50,000 becomes an important level to look at for the Bank Nifty. Moving to CNX 500, which is a broader market index, the index continues to perform because of the good earnings from small and mid cap stocks. The valuations continue to reach new highs and stands at 26.8 times trailing PE. Although we have a gap down from the top, the index may go under time correction for the short term. We believe the broader market will continue to remain buy on dips because of the earnings visibility and the prospects of Indian economy. The sectors that we like are energy, FMCG and pharma. Within energy, ONGC, NTPC, Power Grid and Coal India looks favorable. Within FMCG, you can see that Britannia, ITC, Jyoti Labs, and PGHL. PGHL is Procter and Gamble Health Limited. Within pharma, Pfizer, Marksans Pharma, Venus Remedies, and GlaxoSmith. So you can see that among these three sectors, FMCG and pharma are both defensive. So the charts and the earnings both are favoring the indices except energy. But looking at the prospects of energy sector and the valuation at which they are trading makes them a safe bet in such market scenarios. So we discussed about the Indian markets and the indices. Let's look at what is happening globally. There are a couple of things happening together which didn't happen in a decade. We'll take it one by one and also discuss the impact on the markets. First, the Fed kept interest rates unchanged. The economic data print is not good enough and the bond market is discounting the rate cut. Let's look at the chart of 2 and the 10-year government bond. This is a 2-year US government bond yields. It has fallen by 10%, which is 50 bips in the last 3 trading sessions. The US 10-year bond yield has also fallen close to 35 bips in the last 3 trading sessions. This is basically telling that the market requires Fed to reduce the interest rates, which they were supposed to do in July, but they kept it unchanged. The US is also fearing recession, which is further escalating the need of rate cut. Take a look at the yield curve chart. Whenever the yield curve is below zero, the dashed line on the chart, it is known as an inverted yield curve. This means that short-term interest rates are higher than long-term interest rates. This is the opposite of a normal situation. But whenever the yield curve becomes positive from negative, a recession is expected in a few months. Therefore, the market is ahead of the Fed's interest rate decision. The market may force the Fed to reduce interest rates in September. The second event to discuss is Japan's interest rate policy. The Bank of Japan raised interest rates by 15 bips to 0.25% in its second hike this year and announced plans to taper its bond buying. Traders expect more rate hikes to come later this year as Japanese central bank tries to reduce inflations. This means reducing liquidity in Japan. Why is Japan important for liquidity? For 30 years, Japan had zero interest rates. As a result, for 30 years, investors borrowed in yen at no cost and invested it globally. For the first time in many years, Bank of Japan increased interest rates. As a result, investors are now concerned that the money they borrowed for free is no longer free, and therefore they are unwinding their positions and sending back the funds back to Japan, causing the liquidity to flow in Japanese market, which leads to appreciation in Japanese currency pegged with US. Let's take a look at the US falls in front of Japanese yen. Since 11 July 2024, the US currency in front of Japanese yen has fallen by 9.5%. This is a huge fall. Now imagine you took a loan of 1 lakh yen from Japanese bank and you convert 1 lakh yen to dollar at the rate of 160 yen per dollar. You get $625. This is known as carry trade when you invest this dollars in the US markets or any other markets. Due to Japan's currency appreciation, which we just saw, the USD JPY rate is 146 now. So from 160, it has appreciated to 146. So you will have to pay $685 to convert those dollars into 1 lakh yen. That means you are taking a hit of 9.5% already on the foreign currency conversion of the loan you have taken. Now you also have to pay interest rate because Japanese banks have increased the interest rates from 0 to 0.25%. Such carry trade happens in trillions of dollars. The estimate is 4 trillion at present. The sell off which we are seeing in global markets, including FII selling in India, is because the investors are liquidating the assets to set off the carry trades. The situation is temporary in nature, but it will have short term impact on our markets as well because FIIs will keep selling. But this gives us an opportunity to buy on a price correction. The last one is geopolitical worries. The geopolitical worry in Middle East is also causing a little concern to the markets. Although nothing is alarming as of now, we must see if other countries also join the wars. Important to track is crude oil prices because we import a lot of oil from Iran. Concluding our analysis, the major indices are near life highs, but global worries may become an obstacle for further rally. We like defensive sectors like pharma and FMCG, where the results and the management commentaries are good. The energy sector is also to be watched out. Small and mid cap stocks have continued to perform this result season, and we continue to remain bullish on the order book and the kind of growth they are showing. The global worries is temporary. If you are invested in quality stocks which has growth visibility, you do not need to worry. Our stance is cautiously bullish and add strong stocks in corrections. Always remember that being out of the market is more riskier than being in the market, provided you have done your homework, as Indian markets keeps on giving the opportunities. At Vaya, we make our best efforts to keep you informed about markets through our weekly bite and sectoral update. Thank you and good night.